Welcome to Alpha Recap. I'm glad you joined us for today's market wrap. We're coming to you after the close with a quick, energetic look at the biggest moves and what they mean. As always, if you have questions, you can reach us at stockalpha.ai. And later in the show, I'll tell you how to ask us directly. Ryan, great to have you with me.
Thanks for having me. Big day in the markets. Lots to unpack from January 22nd, 2026.
Let's start with the headline themes. Give us the three big narratives that drove things today.
Sure. First, technology commercialization. Waymo launched fully driverless robotaxi service in Miami, their sixth U.S. market. And that was a clear execution story. Second, macro and commodity hedging. Goldman Sachs put out a bold forecast that gold could hit $5,400 per ounce this year, which pushed the hedging narrative. Third, corporate and regulatory disclosure. A cluster of Form 8K filings from regional banks and small caps brought governance, new debt, and results back into focus.
That's a neat grouping. Tech growth, macro hedges, and back office disclosures. Let's unpack Waymo first. What mattered about the Miami launch?
What mattered is scale. This wasn't just another PR demo. Moving from testing to a commercial rollout in a sixth city gives investors something measurable to watch. Rides per vehicle, utilization, revenue per trip, and the marginal cost of running each ride. Robo-taxis are capital intensive. The business only makes sense if vehicles are busy enough, and maintenance plus insurance costs don't eat the margins. For Alphabet investors, Waymo is increasing operational exposure inside a big, diversified company, which makes it harder to value Waymo separately unless management starts reporting concrete metrics.
People throw the word scalable around a lot. Help our listeners. What exactly do you mean by unit economics in this context?
Unit economics is just a fancy way of saying the math for one ride. How much do you earn from a single trip? That's revenue per ride. And what does it cost to deliver that same trip? That's fuel or electricity, wear and tear, cleaning, remote supervision, and insurance. Then you look at utilization. How many rides a car does per day? High utilization spreads fixed costs across more rides and improves profitability. If Waymo can show a big increase in rides per vehicle without a proportional jump in costs, that's real progress.
Regulation and insurance keep getting thrown into the skeptic pile. How real are those headwinds?
They're very real. Local rules, insurance frameworks, and liability standards vary city by city. Even if the tech is solid, the economics change if insurers charge a steep premium or if regulators limit operating hours or areas. That's why investors wanted to see sustained, repeatable metrics, not just a ribbon cutting.
Switching gears to gold, $5,400 per ounce is a shocking number. What did Goldman's forecast do to markets today?
The forecast put tail risk hedging back on the table. That price implies a very large move from current levels and signals that at least some institutional players are pricing in either much higher inflation, renewed geopolitical shocks, or a drop in real yields that would support a big gold premium. After a geopolitical tariff scare faded, markets stabilized, but that call made people revisit allocations to real assets and miners as insurance.
Should everyday investors reshuffle portfolios based on that one forecast?
No knee-jerk moves. Treat it as a directional scenario. If you use gold as an insurance policy, set an explicit allocation tied to your tail risk budget. Track the drivers that matter: the real 10-year Treasury yield, the US dollar, and central bank commentary. Tactical traders might chase momentum, but strategic allocators should wait for clearer macro signals before making big shifts.
Got it. Now Procter Gamble warned today about a tougher consumer and geopolitical backdrop. That seems important coming from a staples giant.
It is. P&G is a bellwether because they see consumer trends globally. A warning suggests pressure on volumes, pricing, or margin, maybe from input costs, FX headwinds, or weaker demand. Even defensive sectors can't be assumed to be immune. Investors should look for follow-up detail on organic sales, pricing versus volume splits, and what they're seeing in raw material inflation. That will tell you whether this is company-specific or a broader consumer issue.
And then there were those Form 8K filings. That's the kind of thing that often flies under the radar but can be material. Walk us through why these filings mattered today.
Absolutely. There was a cluster of 8Ks covering everything from creation of new obligations to officer departures and results disclosures. Items to watch were Item 2.03, which is the creation of a direct financial obligation. Think new debt that can change leverage and covenants. Item 2.02, results of operations, and Item 9.01, statements and exhibits that often include contracts or financial details. Even routine filings can contain surprises. A new loan with tight covenants, change in control payments for departing executives, or unexpected operational weakness.
Give me an example of a concrete risk an investor might miss if they skip those exhibits.
Say a business files an 8K showing a new credit facility with a covenant that tightens if earnings fall. If you don't read the exhibit, you might miss that a small sales miss could trigger a covenant breach or accelerate repayment. Or an officer departure could come with a large retention payment that hits free cash flow. Those are the subtle details that can affect valuations and credit spreads.
We covered the major moves. Experts seem to agree on some things and debate others. Where did we see consensus and where was there disagreement?
Consensus. Everyone agreed the Waymo Miami rollout was a milestone for expansion and operationalization. Analysts also treated Goldman's call as a noteworthy signal for hedging. An 8K activity was broadly flagged as important to review. The debates were about time horizon and materiality. For Waymo, optimists see a path to material revenue down the road. Skeptics worry about regulation and profitability. For gold, some accept the tail risk thesis. Others say the $5,400 target implies extreme scenarios not supported by current indicators. And for P&G, some view the warning as prudent management caution. Others see it as a sign even staples may be vulnerable.
Give our listeners practical moves to consider based on these stories. What should different types of investors be watching?
Long-term growth investors should ask for measurable KPIs on Waymo: rides per day, revenue per trip, fleet utilization, and safety metrics. Value and income investors should reassess P&G's margin resilience and dividend coverage and read 8Ks for any new debt terms that could squeeze free cash flow. Commodity and macro investors should track real yields, the dollar, and headline geopolitical risk to judge gold's probability. Credit investors need to read Item 2.03 filings closely for covenant changes and maturity ladders. And event or activist investors should scrutinize officer departures and compensatory arrangements for governance openings.
If you had to give 5 quick strategic actions investors could take this week, what would they be?
1. Demand measurable KPIs, not just headlines, especially for Waymo. 2. Treat Goldman's gold forecast as a tail risk scenario and size allocations to a clear budget. 3. Read the 8K exhibits that disclose new debt, operational results, or officer changes. 4. Rebalance sector exposures if you're overly concentrated. Tech commercialization and consumer weakness can move differently. 5. Keep liquidity for event windows so you can act on follow-on disclosures.
Quick reactions. What surprised you most about how the market digested these stories?
2 things. First, how much attention Waymo's single market launch got. Investors are hungry for any sign of repeatability. Second, how a single bold forecast from a major bank can reframe portfolio conversations about hedging. It reminded me that narratives matter just as much as numbers in the short term.
All right, let's close with clear takeaways for listeners.
Bottom line, January 22nd was a cross-currents day. Long horizon innovation advanced with Waymo's Miami robotaxi rollout. Macro hedging narratives got louder with Goldman's $5,400 gold call. And a defensive stalwart warned, reminding investors that sector calm can be fragile. The practical takeaway? Distinguish between structural shifts that need conviction and quantifiable follow-through, and headline events that demand vigilance. Read the exhibits, watch the KPIs, and size hedges to a defined risk budget.
That's a great summary. Thanks, Ryan. Before we go, a reminder to our listeners, if you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai. Thanks for listening to Alpha Recap. We'll be back after the next close with more context and clarity.